Most traders lose money using this pattern. Today, I'll show you why. The hanging man doesn't fail. It's the way most traders use it. So by the end of this video, you'll know exactly when it works and when it fails. Now, let's see how this looks in the real market. Here, we have a potential hanging man, forming right at a key resistance level. And this is important, because it suggests that sellers may be stepping in at higher prices. But here's the problem. This alone is not a valid signal. This is where most traders go wrong. They see the pattern and enter too early. But in reality, this is only a potential setup. We still need confirmation before taking any action. So before we go further, let me show you the structure of a hanging man, so you understand exactly what you're looking at. Let me show you the structure of a hanging man. The small body at the top represents the opening and closing price. And this long lower shadow shows that price was pushed down strongly during the session, but buyers managed to bring it back up. This rejection from lower levels is what makes the pattern important. The longer the lower shadow, the stronger the rejection. As for the upper shadow, it should be little to none. However, even if there is a small upper shadow, it can still be considered a valid hanging man. The hanging man was named by Japanese traders because of its appearance. The candle looks like a hanging man, where the body represents the head, and the long lower shadow looks like dangling legs. This visual makes it easier for traders to quickly recognize the pattern on a chart. Now, there are a few key rules you need to remember. First, the hanging man must form at the top of an uptrend, ideally at a key resistance level. This is the most important condition. Second, it requires bearish confirmation from the next candle. Without confirmation, the pattern is not reliable. The color of the candle is not very important. It can be either red or green, although a red candle is slightly more bearish. The hanging man and the hammer look exactly the same, but the key difference is where they appear. Now, let's look at this on a chart. When this pattern forms at the top of an uptrend, it's called a hanging man, and it signals a potential move down. On the other hand, when it forms at the bottom of a downtrend, it's called a hammer, and it signals a potential move up. So even though the structure is the same, the meaning completely depends on the trend before it. That's why in candlestick trading, location is more important than shape. The same candle can be bullish or bearish. It all depends on where it appears in the market. So remember, same structure, but completely different meaning depending on location. Now let's look at the market psychology behind the hanging man. After a strong uptrend, the market is bullish. Buyers are clearly in control. As price continues to move higher, momentum remains strong. But then, this hanging man forms at the top of the trend. This is the first sign of weakness, a rejection from higher prices. The long lower shadow shows that price was pushed down aggressively during the session. Although buyers managed to push the price back up, this reveals underlying weakness. It tells us that selling pressure is starting to appear. So at this point, we don't enter immediately. We wait for confirmation. If price breaks below this confirmation level, it shows that sellers are now taking control. To understand this better, let's look inside the candle. And remember, with the hanging man, you don't need to memorize the pattern. What really matters is understanding the battle between buyers and sellers. If you find this lesson helpful, feel free to subscribe to Market Structure Logic for more trading content. Now let's break down the candle step by step and understand what's really happening inside the hanging man. At the start of the session, price may open higher, which still looks bullish. But then sellers step in and push the price down aggressively. This creates the long lower shadow. This tells us that sellers were strong during the session. Later, buyers step back in and push the price higher again, forming a small body near the top. So at first glance, the market still looks strong. But underneath, something has changed. Selling pressure has started to build. This is why the hanging man is an early warning signal. It shows that the uptrend may be losing strength. And remember, the story behind the candle is more important than the shape. And this is where smart traders start paying attention. As we saw in the previous slide, the pattern alone is not enough. That's why we need confirmation. After the hanging man forms, we look at the next candle. This is the confirmation candle. If it opens lower and closes bearish, it shows that selling pressure is increasing. Ideally, price should close below the hanging man's low. This gives stronger confirmation. A more aggressive approach is to use a break below the hanging man's body as an early entry, but this comes with higher risk. When this happens, it tells us that sellers are now taking control, and a potential reversal may follow. The pattern gives us the warning, but the next candle gives us the decision. This is important, because the hanging man still shows some buying strength. But once price breaks below that level, those buyers become trapped, and sellers take control. This is where traders start looking for short opportunities. This is where smart traders take action. And remember, without confirmation, the pattern is not reliable. With confirmation, the probability of a reversal increases significantly. So always enter after confirmation, not before. Now let's look at a real example where the hanging man fails. This is what happens when there is no confirmation. Here, we can see a potential hanging man forming at the top. At first glance, it looks like a bearish signal. But what happens next is the key. Instead of moving lower, price moves higher and breaks above the high of the hanging man, which tells us one thing: buyers remain in control. The selling pressure simply wasn't strong enough. So this setup is not confirmed, and the signal is invalid. Anyone who entered early is now on the wrong side. This is exactly why confirmation matters. No confirmation, no trade. Before we end part 1, let's do a quick final revision. I repeat this because this is where most traders make mistakes. Here, we can clearly see a hanging man at the top of the trend. But remember, the pattern alone means nothing. So what do we wait for? Confirmation. The next candle opens lower and closes bearish. This tells us one thing: sellers are stepping in. This is the confirmation candle. And once price breaks below that level, that becomes our entry signal. This is where traders look for short opportunities. And as you can see, price continues to move lower, confirming the reversal. Without confirmation, there is no trade. That's why we never trade the pattern alone. In the next video, I'll show you exactly where to place your stop loss and how to take profit with proper risk management. If you want to trade this like a professional, you don't want to miss it. Now let's conclude part 1 by locking in the key takeaways. First, always check the location. The hanging man must form at the top of an uptrend. Second, the pattern alone is not enough. No confirmation, no trade. Third, always wait for the next candle. Confirmation tells us if sellers are truly taking control. And remember, a strong signal plus confirmation leads to a higher probability trade. Trade with logic, not emotion. If you want to trade this properly, follow market structure logic, and I'll show you step by step. In the next lesson, I'll show you how to turn this into a complete trading setup, including what most traders miss, how to identify stronger signals, like gap up and gap down, and exactly where to place your stop loss and take profit. If you want to trade with structure, subscribe to Market Structure Logic, and I'll break it down step by step. I'll see you in the next lesson.